Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Investing solely in your home country's stock market can limit your portfolio's potential. International equity ETFs offer a straightforward way to tap into growth opportunities around the world. They let you invest in companies outside your domestic market, spreading your investments across different economies. Consider VXUS, a popular example that provides broad exposure to international stocks. Including such an ETF in your portfolio helps with global diversification. This strategy can reduce risk and potentially boost returns over time, giving you access to markets that may outperform your own. What are international equity ETFs and why consider them? International Equity Exchange-Traded Funds, ETFs, are investment funds that hold stocks of companies located outside your home country. Think of them as a diverse basket of international stocks. Unlike domestic ETFs which focus on your local market, international ETFs offer a simple way to invest globally. They differ from actively managed international funds because they typically track an index, meaning their holdings are determined by rules, not by a fund manager making individual stock picks. This structure often leads to lower fees for investors. Now, let's explore why these ETFs are a smart addition to your investment plan. Diversification beyond borders, reducing risk and enhancing returns. One of the biggest reasons to consider international equity ETFs is geographical diversification. By spreading your investments beyond a single country, you can potentially reduce the overall risk in your portfolio. Markets around the world don't always move in the same direction at the same time. For example, when your home market faces a downturn, international markets might be performing well, offsetting some of those losses. This idea is called low correlation. It means that the returns of domestic and international markets often don't have a strong, direct relationship. Imagine you have all your eggs in one basket and that basket drops. That's a big problem. But if you distribute your eggs into several baskets and one drops, you still have the others. Similarly, if the US stock market declines due to an economic slowdown, strong performance in European or Asian markets could help smooth out your total portfolio returns. This balance can lead to a more stable investment journey over time. Accessing global growth opportunities. International markets, especially in developing regions, can offer higher growth potential compared to more established domestic economies. These areas are often undergoing significant economic development and demographic shifts. For instance, many emerging markets benefit from a growing middle class, increasing consumer spending, and rapid technological adoption. Consider countries in Asia or Latin America experiencing robust industrialization and infrastructure building. They may see faster corporate earnings growth than companies in mature Western markets. You might find international ETFs providing exposure to leading companies in sectors like renewable energy in Europe, advanced manufacturing in Asia, or consumer staples in fast-growing developing economies. Investing in international equity ETFs allows you to capture these exciting opportunities and participate in the global economy's expansion. Key considerations before investing in international equity ETFs. Investing in international equity ETFs offers many benefits, as we've discussed. However, it's also wise to understand the potential complexities. Before you jump into global markets, there are a few important factors to consider. Being informed about these can help you make smarter investment choices and manage your expectations. Understanding currency risk and its impact. When you invest in international markets, you're not just investing in foreign companies. You're also investing in foreign currencies. This introduces currency risk. Here's how it works. The value of foreign currencies can fluctuate against your home currency, like the US dollar. Imagine you invest in a European ETF. If the euro strengthens against the dollar, your investment, when converted back to dollars, will be worth more. This is a positive impact. However, if the euro weakens, your investment will be worth less in dollar terms, even if the underlying European stocks performed well. This negative impact can reduce your overall returns. Some ETFs are currency hedged, meaning they try to neutralize these currency movements. While this might sound appealing, currency hedging adds complexity and can introduce its own set of costs and risks. It's often best for most investors to accept the currency exposure as part of international investing since it can also work in your favor. Expense ratios and tracking error. What to watch for? When evaluating any ETF, its expense ratio is a critical number. This is the annual fee the fund charges as a percentage of your investment. Even tiny differences in expense ratios can significantly impact your long-term returns. For example, a fund charging 0.50% versus one charging 0.10% means you're paying 5 times more in fees, which eats into your profits year after year. Another important metric for passively managed ETFs is tracking error. This measures how closely an ETF's performance mirrors the index it aims to track. A lower tracking error means the ETF is doing a better job of replicating its benchmark. For instance, if an index returns 10%, an ETF with low tracking error should also return close to 10%, after fees. A higher tracking error suggests the fund isn't sticking to its target effectively, which can lead to unexpected returns. For example, VXUS has a very competitive expense ratio of 0.07%. This is significantly lower than the industry average for international equity ETFs, which can range from 0.20% to over 0.50%. This low fee directly benefits your investment growth over time. Navigating geographic and sector exposure. Before investing, take time to understand what your international ETF actually holds. Not all international ETFs are the same. Some might focus heavily on developed markets like Europe and Japan, while others lean more towards emerging markets in Asia, Latin America, or Africa. Here are a few ways ETFs can differ. Developed versus emerging markets. Developed markets tend to be more stable but might offer slower growth. Emerging markets can provide higher growth potential but come with increased volatility and risk. Regional focus. An ETF might concentrate on specific regions, such as a Europe-only or Asia-Pacific fund, rather than a broad global ex-US approach. Sector allocations. Just like domestic funds, international ETFs have different weightings in sectors like technology, financials, or healthcare. You need to assess if the ETF's specific geographic and sector exposure aligns with your personal investment goals and risk tolerance. Does it complement your existing portfolio? Does it provide the type of international diversification you are seeking? Think about whether you want broad market coverage or a more targeted approach to a specific region or type of economy. Stay tuned for Part 2, where we'll explore VXUS in detail, including its holdings, performance, and how to use it effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.